I'm glad that talk was cut off short because they were touching on a lot of what I was going to talk about. So there might be some duplicative stuff. Cool. So yes, VC funding and interactive entertainment. Yeah, these things I'll go over, not super important. I'll give you a bit of background about Makers Fund, and then dig into VC funding, and then why and how to get VC funding, and then what do VCs look for. And I think that this is a kind of presentation I've given a couple times because I think that there is a lack of understanding on how VCs work and what they look for and how they make money. That I think, if understood, really helps to kind of make sense of some of the decisions VCs make and might help you understand feedback or potential funding sources if you really get what they're thinking about. So Makers Fund was set up in 2017. So I joined in 2019 to be the kind of on-the-ground presence in Europe. I'm now principal, help leading the European team. And I think it's funny I can say I'm one of the most experienced games investors in the world because I started in 2019 and very few people were investing before then. Before that, I was at McKinsey, a consultancy, and did a lot of the games work there, and spent a lot of time trying to get investors to invest in games, and it was really hard. I remember speaking to a private equity client that was looking into making an investment in a very large battle royale studio, and he said to me, yeah, my grandkid's really into this game. I think maybe one day this could be as big as film. And I was like, yeah, it's like 10 times bigger already, And I think it just goes to show, the investment community and the games community the Venn diagram is very thin. I always loved games, so I jumped at the opportunities to join a startup VC fund, Makers Fund in 2019, tail end of Fund 1. And then COVID hit, and the best decision I ever made in my life. So we've now, on our third fund, we have over $1 billion under management. We've actually probably made over 100 investments as well in more than 15 countries. So we focus on Series A stage. So maybe just to kind of step back on what is VC. VC is a type of financing in which you take a minority equity stake in early stage companies with a very high risk profile. VCs return their money. They make money when companies they invest in exit, i.e. sell. It's also called a liquidity event. That can happen through being acquired, M&A, or through IPOing. And they take kind of long-term time horizons, 5+ years, pretty typical. VCs do not get involved in the operations of their companies. They are minority shareholders. They do not own or control their companies, but they do provide advice and support, or at least the good ones do. So that's kind of an overview of what a VC fund is. So I thought this might be helpful to kind of situate VC because it can help understand the broad spectrum of things it covers. So the company lifetime, and then funding round, type of investor. So venture capital can cover a very, very broad section, but the earliest companies, and the thing I'm really missing here is actually kind of debt and grant funding, which I'll talk about later. But if you think about equity investing, so angels, wealthy individuals, typically ex-founders, will invest in domain areas they know a lot about. And then more institutional investors, what we're called, will come in at kind of seed, maybe pre-seed stage, right up to Series D. And then, the line blurs between VC and growth because growth is still minority. And then as you get to later stage, you get to private equity, which is buyout. So that's when they buy the complete organization. For a lot of industries, that's a very typical venture exit, is buyout. And one of the reasons that VC funding has been difficult in games is because venture funds, private equity funds, do not buy games companies because they do not understand the industry. And so the exit options have been limited because IPO, which is the final one, then hedge funds invest in IPO in public companies, you have to be pretty big to IPO. So for a lot of other B2B SaaS businesses, there's a very clear path to exit to a private equity fund if you can get to X amount of revenue. And that's not really been the case for games, which has contributed to why it's been difficult to fund. So the conventional funding options for games have been really like venture capital and publishing. So this is a breakdown of kind of those two main options that I think a lot of particularly content companies will think about. So this is an overview of some of the key differences, right? So in venture capital, you're investing in the company. This is reiterating a lot of what you just heard, right? So venture capital, you're investing in the company, not the game, right? So That could be a one-game company. Riot is a good example of a VC-funded studio that, until very recently, was a one-game company and certainly made a nice $10 billion exit as a one-game company. But it's often not, right? And so what I look for when I look at an investment is, what is your kind of studio thesis? And it has to normally be broader than a single game. There's publishers, they invest in a project. They invest in a specific game. The timeline's also different. Venture funders expect returns from 3 to 10 years. Publishers typically looking for 1 to 3 years. The return model is very different. Exit, liquidity event, and revenue share. You can have a very, very successful game and not be able to sell your company. And we'll talk about why that is. So that's why there are some very, very successful games companies that we would never invest in. Because selling your company requires a certain type of business model, whereas just succeeding on a product and getting revenue, it can be pretty general. And then the involvement is also, I think, something that I hear a lot. I don't want to take VC funding. I don't want to give up that much control. You give up a lot less control than when you go with a publisher, because VC funds will not get operationally involved. They'll sit on your board. They'll ask for financial protections. They'll give advice, but they generally don't have operational control over your fund, over your company. Whereas publishers will generally ask for some kind of creative or kind of commercial control. They'll often really involve themselves in your operations. Now that can be a good thing or a bad thing depending on what you're looking for. And then really all of that sums up to the kind of last two, which are the most important. So risk tolerance and degree of control. So VC, kind of typical return model for a VC is, you make a lot of money on 1 or 2 investments over a 10-year time horizon. That's how VC funds work. Publishers, but you might do 1 in 10 companies. Everyone knows that probably. Publishers, you're expecting about a 50% hit rate, and you're expecting 2 to 3 times your money, and you're expecting that in a 2 to 3 times time horizon. And I'm not going to go, I used to have a page in here that went into like IRR and finance stuff, but I was told it was very boring. But when you kind of average out the annualized returns of both those models, they're actually pretty similar. But we're just looking for much bigger bets over a longer time horizon and a higher risk, whereas publishers are more conservative, shorter time horizon, and lower return profile. So, but the annualized returns are fairly similar. Yes, so this is VC funding, right? I think a lot of you are probably familiar with this. I'm a VC fund. I make an investment in these are millions. Okay, make a $2 million investment in a $10 million company. And here I normally explain these words pre-money and post-money, which I think are like unnecessarily confusing. So if you look at the now company that's worth 10 million, so the valuations refer to whether it is pre the investment or post the investment. So if you had a company that was all cash, let's say, and it was 8 million in cash, and then I gave it 2 more million, right? Its pre-money valuation is 8 million, and its post-money valuation is 10 million, because 8 plus 2 equals 10. A company is fundamentally equity, which is a kind of amorphous concept that in theory refers to the kind of assets and minus the liabilities of the company. So, pre-money is basically what we think the company is worth before you give the cash, and then once you give the cash, that's just added cash balance. So the model here is I want to make an investment where I take 20% of this business, $2 million on 10, pretty typical seed or in Europe, Series A investment maybe. And then, 5 years later, great, they didn't have to raise any more money, so they don't have to worry about dilution. And they sell for 100 million. That's great. I made a 10x return. So the VC profit here is 18 million, which is pretty good. But it also demonstrates something that is important to understand, which is that, and by the way, the VC equity, founder equity, this just goes to show, this is a pretty typical post-Series A ownership cap table, is 20% of the business to be owned by the VC fund, 80% by founders or the working team. Which is, the thing that's important to understand is that there's relative return and there's absolute return. So this is something I have to confront a lot, because our latest fund is a $500 million fund. It's a pretty big fund. So for us, this investment wouldn't actually make sense, because $18 million is very nice profit, but it doesn't really move the needle when you're expecting a 1 in 10 hit rate and you have a $500 million fund, because we're expected to return 2x that fund. So we have to return $1 billion, And so, 18 million is great, and it's an amazing absolute relative return, but it's not that good for a larger fund. So that's why I think, depending on what you're raising, you should really think about which funds you're reaching out to. For a $60 million fund, an $18 million return is transformative, right? That's like, nearly a third of the fund. So depending on what your return profile is and your potential exit value, you might target different funds. So we can get into this a bit further, but Roblox is a pretty good example, and Roblox was around forever. So they raised tons of capital. They got to Series H, which is funny. And if you look at the round sizes, right, they did a couple small million rounds, over a couple of years, and they started to do some bigger ones and bigger ones and bigger ones, and they finally got to, the kind of like big pre-IPO round, 855 million, on a post-money valuation of 28.5 million. They IPO'd at 30 million. So, if you look at this, the first investor in January 2005 got in when it was worth 2 million, and then, 15 years later, it's worth 40 million. 40 billion, sorry. There's a pretty good relative return. I mean, I can't even calculate that, right? 2 million out of 40 billion. And so you look at that and you think, okay, well, that's compelling. So then you look at the actual kind of like absolute return. So this is the percentage of the company they earned when it IPO'd times the IPO value. So what you can see here is that a lot of them kind of roughly returned the same amount in terms of investor return, which makes sense because a lot of them are buying the same portion of the company. So if I'm investing 335 million on a 4 billion valuation, I'm getting about 10% of the company, maybe a bit less. So I'm going to get 10%. Same, and if you do the math on all of these, you'll see a lot of them are around 10%, just under. They were in a good position. But what you'll notice is that, like, in terms of just total return, they're pretty similar, right? And then if you look at the amount invested, you actually can't see it for the first, like, 6. It's only when it starts with 150 million in the Series F that you can see it. And so the investment multiples, which is the kind of like first line of bubbles, are very different, right? I mean, like I said, one of them got like a 2,611 investment multiple. This might be very boring, but if you bear with me, I'll get to more interesting stuff, because it's very important. Whereas, the guys at Series F had a 14x investment multiple, which, relatively is like astronomically different. But if you look at the absolute return they generated, it's pretty similar, right? 2.8 billion versus 1.9 billion. So relative return is not the whole picture, and I think a lot of people think, well, that's why negotiating on valuation sometimes doesn't work. So if a company comes to me and says, oh, we want to do this deal, 10 million, and they go down to 5, I'm like, it doesn't really matter, because if I don't think that company can sell for over $1 billion, my absolute returns are never going to be more than 20 million. So it's a very British thing to think if you ask for less money and you ask at a lower valuation, you're more likely to get the investment. But it generally doesn't really work out because the fund size doesn't really fit. So there are funds out there that have smaller fund sizes. So Play Ventures, phenomenal fund, right? Smaller fund sizes, goes after Series seed bets, right? Their first fund was 60 million. So they could do an investment at 10 million, and if it sold for 100, it would make a big difference to their fund. So you guys should all think about that when you think about fundraising, is what is the potential exit value? And that is a very good question. And I think maybe we'll get to it later, but different companies have different potential exit. And that's almost all the feedback you'll get for a VC has something to do with how much they think you can sell for. And so there are some businesses that just have pretty hard caps on what their potential exit is. Luckily, content actually isn't one of those businesses. But B2B tools, there's a lot of B2B tools I see where they're raising a 10 million valuation, and I probably have like a 50% likelihood that these things will sell for more than 100 million, right? Seems like a really good investment, but there's basically no way they'll sell for more than 200, because one, the revenue that they can get to isn't that big. Like if you're making some specialist audio software for the games industry, if you just size the market, even if you assume 100% penetration, they'd probably get to tens of millions in revenue. And then the potential acquirers are pretty limited, right? There's Epic, there's Unity, there's a couple others. And so what that means is that, Epic's either going to buy you for 200, 300 million. If it gets more than that, they'll build it themselves. And so for tools companies, that's often a challenge we face, is very, very hard to justify an outsized exit. Luckily, with content, you can. So why raise VC? And we can do a Q&A after this. You can ask more about that if you're interested. So why raise VC? So obviously, funding is the obvious example, but what does that mean? So one is pre-revenue financing to develop a product. The other one is scaling up faster. You might want to bring certain capabilities in-house, depending on what situation you're in, right? So the first one would be like a team that comes to me with a concept for a game. We give them funding to build that concept. The second one might be a team that has soft launched a game, really wants to jumpstart scale. Third one might be a team that's been working with a publisher, bring that in-house. You go on a second game, et cetera, et cetera. I do think the last two here are important to flag because I think they're under kind of considered, but a good VC should really be providing additional value beyond just funding. There's a lot of dumb money out there, and so you should also really consider the kind of other benefits, qualitative benefits a good venture capitalist can bring, and that's everything from having a logo on your website that helps you recruit to having a global network of advisors like we do that can get you preferred status at whatever engine you're using. So filtering VC funds, I might skip this, we can come back to it. And then this is the kind of process for VC. It could take a while, I said that earlier, but you should find the right VC, I think is really one of the kind of key steps a lot of people miss is you're going to waste a lot of time if you're pitching VCs that will never take your money, either because they don't do games. I get so many pitches for med tech, startups, and I'm like, guys, we invest in games. That's it. We don't do med tech. And then you prepare materials, pitch and due diligence, and you want to iterate on materials based on feedback. Term sheet negotiations, that's pretty much when the deal's done unless something bad comes up. In legal due diligence, final negotiations go to closing. So what do VCs look for? Now, you've probably heard every one of these, but we could talk a bit more about them. So great team, relevant experience. What does that mean? One, experienced teams. This myth that college dropouts are startup founders is absurd and untrue. Most successful startup founders are in their 30s or 40s when they found their startup. So we really would look for relevant experience in what you're trying to do. One of our best performing investments is Dream Games, recently valued. Oh. Does that work? Oh, yeah. Yeah, so one of our investments, Dream Games. So when we invested in, when they were kind of 25 million valuation, just a team, but they built Toon Blast and Toy Blast, right? They built those games, and they wanted to build a match game. And so it was great team, as good as you could ask for with relevant experience. Sustainable competitive edge. This is one I think you might have a short-term. If your competitive edge is your idea, that's not a competitive edge. Because once you prove the idea, someone with more resources will go out and adopt it. So you really got to think about in the long run, how do you maintain your position, and then founder-owned independent, right? So we really look for companies where founders and working teams are incentivized to be aligned in the company's success. So if your company is not majority owned by founders, or even you're heavily diluted, that's a problem. So you guys should all think carefully about which investments you take, what the org structure of company is. Spin-outs often have this problem where a corporation just owns 100% of it. That's something a lot of VCs don't like. Then the market factors, I think, are ones founders don't think about as much because obviously you're product people and we invest in great product people. But you want to find a market that is big and really big. That's my point about potential exits, right? You might have an amazing market with an amazing edge and the best product in it, solving a massive problem for a lot of people, but it just you can't imagine getting a large revenue number. Clear exit options, and we can talk about those. And then scalable revenue potential is pretty similar to what I was talking about. But I would say scalable revenue potential, I would also maybe adjust, and clear exit options. That's a lot to do with business models. So we can talk about this, but we do not really fund premium games companies because they don't really have a path to exit. They're very good candidates for project-based funding, but for various reasons, they're much harder to sell. So maybe the final thing I'll touch on, and it was great because you spoke about it earlier, is there are non-diluted funding sources. And these are just a list of debt instruments, but there's also grants. every one of our Finnish companies gets like, 2 million euros from the Finnish government. It's incredible. England's doing a better and better job at that, but you should definitely be exploring all of the free Epic mega grants, all of that. And then there's debt facilities. Often companies will come to us raising a Series A. They'll say, I want to raise 15 million, and 5 million is for growing the team, and then 10 million is to fund user acquisition on a mobile game. I'd be like, sounds like you should raise 7 million, 5 million to fund the team, 2 million to start user acquisition, and then you can debt finance the rest. Because there are, like, a line of credit is a very cheap, non-dilutive way of financing that. It depends on your company position. So that's pretty much everything I had. I figured, it'd be helpful to, get your questions about any of that or anything else, if there's time.
Good stuff. Thanks, Archie. Great. Anybody got any questions about how to make 40 billion from their companies?
We'll make it fun. We'll make it fun. Feel free to ask about Makers, our investment strategy.
Yeah, good stuff. Anybody got any questions? Yep.
Thanks very much. So I'm seeing a trend at the moment with publishers gearing up to IPO, and they're acquiring studios. So that's kind of like a new sort of exit route that's happened over the last few years. I was just wondering what you think is going to happen over the next 5 years. Like, what other routes to exit are there going to be for indie game developers?
Yeah, that's great. That's a great question because it touches on a very interesting phenomenon. So, one premium game developer is not a good business to sell. 15 premium game developers is a good business to sell. And so often what those businesses are doing are taking advantage of valuation arbitrage. That basically just means the difference in valuation in private markets versus public markets. So there's a couple of big examples. Embracer was one of the first, Stillfront, Devolver, TinyBuild. Now, that has been, I think, a very good play in the indie market. I think about it like there's a matrix of PC, console, mobile, free-to-play, premium. And you kind of have Stillfront in the free-to-play mobile. You kind of have Embracer. They move outside of these lanes in premium PC console. And there's a lot more value often, especially on public markets, in having a bunch of these games. And one of the reasons for this is that investors don't like lumpy revenue and unpredictability. And so even if you have a company like Grand Theft Auto, right? I mean, they have a little different with it online. But even if you make $1 billion every 5 years, but then you make nothing, and then you make $1 billion. Investors would much rather you just made like 200 million every year because it's sustainable, it's predictable. You can, the current value of a company is in theory the discounted future cash flows, and so you want those cash flows to be predictable. It's why premium games are very hard to sell because the next game is high risk. So that risk gets mitigated when you have a broad portfolio. So that's one of the reasons you've seen the roll-ups. I do think you've seen, the impact from COVID has really kind of brought games out of, a subculture and into the mainstream of investors' minds in a way that is unique. I think there's been a retreat from that. But someone like Carlyle buying Jagex, the developers of RuneScape, would never have happened 5 years ago, 3 years ago, 2 years ago. So, that's a private equity exit. And so maybe that will open up new routes. I think there will be new roll-up opportunities because I think that there always are as prices dip. I think that we're about to see a flood of VC. So the amount of VC funding into content over the last couple of years has been crazy, and at absurd valuations. And I hate it because I speak to all these VC funds who are like, yes, hit-driven business. Our VC funds, our game's not doing well. I'm like, yeah, well, you made an insane investment in a not very good studio at a crazy valuation. Like, we were pretty conservative because we knew that everyone would draw back because that's what everyone does. And now we're making investments in a lot of those studios. But that's been heavily concentrated in PC console free-to-play. So if you look at all the ex-Riot founders, all of Andreessen Horowitz's investments, all of them are great teams making great games. But, literally, like these companies have billions of capital invested in them. And we have not seen that kind of production budget behind free-to-play games ever, right? Like, think about how many free-to-play games with big production budgets were released each year over the last 10 years. We're about to see 15 of those a year for the next 3 years. So I think that's going to be a bloodbath. I think it'll be really interesting to see who succeeds and what happens to that market. Proletariat was recently acquired by Activision for $100 million. That was about $1 million per person acqui-hire. Because they didn't acquire it for financial reasons or the game's success. I think that appetite is limited. I don't think that they're going to continue playing $1 million or higher. So I think that it'll be interesting to see what happens to a lot of these studios that can't really find a home. One other comment I'll make, and then we can move on, is that Cepheus Enforcement, which is the U.S. government's basically enforcement against foreign companies buying American companies, has really expanded. It began with Grindr, and then it was TikTok, and now games companies. And so a lot of these companies exited to Tencent, NetEase, et cetera. And those guys, the regulatory landscape in America seems a bit more hostile now. So they're all looking at Europe. And so I think that creates new opportunities for Europe to kind of take advantage of that as an emerging place. Europe's also got a phenomenal pool of capital with pool of talent with less traditional venture funding, but increasingly so. So I think we'll see a rise of Europe. I think we'll see some creative new roll-up type strategies, conglomeration strategies, and I think we'll see a real glut, just flood of free-to-play content that is going to leave a lot of bodies probably.
Great. I think we've got time for one more question. If anybody's got a question, yep.
I think you probably answered some of my previous question with that, so thanks. But what's your kind of main, given the sort of challenges of getting big enough companies to be interesting in terms of the exit, what's your main kind of pipeline? What's your source of finding those companies? What kind of channels do you use for that?
Great question. So often I'll know. The two most recent investments I made, I knew those founders for 3 years before I invested, and I met some of them at conferences like this, often through people who know people who know people, right? So like the previous panelists, like law firms. I do think it's worth going to these conferences because you will, get to meet these investors, and if it's not the right time now, it might be later. And especially with later stage investors, it can take a while to get comfortable and to get to a stage, and they can hopefully, if they're good, they can give you feedback on what they need to see. Oh, sorry, can you still hear me? I do still think though that professional network and a warm intro is always best. So if you can get someone who, ideally just knows the VC, but even better would be someone who's worked with you and would speak highly of you, that changes everything. That's one of the reasons that Riot and Blizzard employees have had such easy times funding, is because a lot of them have been in the VC startup world, and so there's kind of a cyclical nature. You've had to let that less out of European studios. Yeah.
Super. I'm afraid we've run out of time there, but big thanks to Archie Stonehill.
Oh, thank you.
Brilliant. Thank you.
Yeah. Feel free to come up and ask any questions as well.
Yeah, that's great. Thanks, Archie, and thanks to all our speakers today. We'll be back for the second day of GI Live London tomorrow with more meetings from 10 a.m. to 6 p.m. Roundtables from 10 a.m. and our first roundtable tomorrow is Creative UK. So if you want to find out more about their support for games, come along tomorrow at 10 a.m. We have a lunch from 12:30, and then we kick off with the talks and panels from 1:30 p.m.